Dear all, MeDirect thanks you for joining this webinar, the 10th in our MeDirect Talk series, where we feature several financial experts and asset managers sharing their views on market and investment opportunities. MeDirect has always been at the forefront of providing you with the latest on the investment world, and we aim to continue doing so through our regular updates on our website and social media. Our team of experienced wealth advisors are always available to assist you. This time round, we are addressing the very topical subject of inflation and what should be done about it. Some of the questions we will be addressing today are the following. Is the world now entering a new era of high inflation? Is this a structural shift which will erode the real wealth of your asset base? How does one prepare a multi-asset portfolio for such uncertainty? Joining us today is Mike Coop, Chief Investment Officer at Morningstar. Mike has great experience in multi-asset investing and a passion for delivering great returns to the end investor. Since joining Morningstar, he has been working within the investment team across the world to ensure their process remains at the leading edge of developments in multi-asset portfolio management. As most of you are aware, Morningstar is a leading provider of independent investment research in North America, Europe, Australia, and Asia. Morningstar provides data and research insights on a wide range of investment offerings, including managed investment products, publicly listed companies, private capital markets, debt securities, and real-time global market data. Following the presentation by Mike, we will be having a Q&A session. I would like to take the opportunity to thank all of you who already submitted some very interesting questions via email. Throughout the session, please feel free to send us any other additional questions you might have through the Q&A function. Mike, over to you.
Thank you very much, Ingrid, and it's an absolute delight to be here. Thank you all for dialing in. So without any further ado, let's get straight into the presentation. What we're aiming to cover is how inflation has behaved over time, the sort of returns you get from shares and bonds in different inflation regimes, and then look more closely at what's been happening to inflation lately. We'll talk about our inflation outlook, and then we'll just touch upon how we think about what inflation means when we're running multi-asset portfolios, including the MeDirect model portfolio. So let's start by looking at a long-term chart of inflation. What we're really talking about, of course, is the price that you pay when you buy goods and pay for services. And as I'm sure you'll have all noticed, some things have gone up quite a lot in price and are costing more than they used to. Why that's important, of course, as savers, is that the whole point of saving money today is that you can then buy more with that savings in the future. So inflation is very important as we think about how we protect against higher prices in the future, meaning we'll be able to buy less in the future than we can today. What I'm showing you here is a chart of inflation in the United Kingdom back over 150 years, and the blue line is showing you the year-on-year change in the cost of things. And obviously the higher the line, the higher the level of inflation, the lower the line, the lower the change in prices. In fact, in some cases, prices actually fell. So you can see here that there are periods of time when prices go up a lot. There are periods of time when prices go down a lot, but actually most of the time prices rise by a little amount. So what we wanted to do as we think about inflation is to understand the different types of inflation environments and what that means from an investment point of view. So here we're showing the breakdown of inflation. And the way we've done it is that we've thought about history in terms of those periods of time when the prices of goods and services are actually going down, which is deflation. And we've had a look to see how often that happens over this particular historic period. And we found that that happens about 8% of the time. We then looked at periods when prices don't really move very much. We've called that price stability. That happened about 15% of the time. And then we have low inflation, which is really the environment we've been in for the last 25 years, where inflation is going up by between about 1% and 3% each year on average. And that happened about a quarter of the time. Then we have medium inflation, where inflation is averaging between 3% and 5%. And that was also about a quarter of the time. And then we had high inflation. And I should also add that all of the data we're showing here corresponds to 3-year periods. So we can see here that we're in a low inflation environment. Of course, what we want to know is, if we were in a low inflation environment, how likely would it be that we would move to a high inflation environment? So a high inflation environment is where inflation is going up by 5% or more a year, because that's what really where we start to see a big difference in the returns we get from shares and bonds that back up our investments. So in the past, if you were in a low inflation environment like we are today, the chances of you moving to a high inflation environment in the next 3 years was really pretty low. In fact, it was 14%. Now, this data is UK data. We find a very similar pattern. So the inflation that we should be worried about is 5% or more per annum. And the reason for that is that in that situation, we tend to find the return from equities is lower than we'd normally see. This chart shows you the average return you get after inflation from shares. And on the far left, we can see that number of 9.1%, which is what's occurred in deflationary periods. We can also see it then moving from left to right as we go from deflation to price stability to low inflation. We had 4.9% as our return after inflation, 10%, and then in high inflation, a return after inflation of 0.8%. The colored area represents what's happened 3/4 of the time, and then you can see the top and the bottom of the band is the maximum and minimum. So it's high inflation you have to worry about. The other investment we all hold in portfolios are government bonds. So we're showing the same information here for government bonds. The far left shows the return after inflation of government bonds in a period where we have deflation. And those returns are pretty good because those interest payments, those coupons that we get from bonds, and don't forget, when we're buying bonds, really it's a bit like money in the bank. We're getting interest payments, and then we're getting our money paid back to us at the end of the period. And the returns we're showing are a combination of those interest payments and getting that money back, except with bonds, there's a little more of an adjustment process going on. But most of this is talking about the income return you get as well as the price. So basically, deflation is very good for bonds. But as we move from left to right on the chart, you can see those numbers start to change. And when we're in a high inflation environment, you get a minus 3.1% per annum average return from bonds after inflation. So the return's a lot lower, and most of the bar that you can see in that far right is actually below zero. So high inflation is the enemy here in terms of the return we get from bonds as well as equities. So before we move on to look at how inflation looks today, the main points I'd like to leave you with are, firstly, that we are still in a low inflation environment where the average 3-year inflation is between 1% and 3%. Big shifts in inflation regimes, such as moving from where we are today to a situation where inflation is averaging over 5% per annum on a continual basis, those sort of shifts are pretty rare. What that means is a lot of things have to change before you get that transition. And high inflation is the sort of environment where we tend to get lower returns for equities as well as for bonds. A medium inflation, where we're averaging inflation of 3 to 5%, you can still get reasonable returns from equities, but it's when you get to that 5% plus, really, that you start to see the return from equities being pretty low. And so overall, your returns are going to be low. Let's have a look now at what's been happening with inflation. So here we can see a chart of the oil price. And here we're showing 2 measures of oil. One is a US-based measure, West Texas Intermediate, WTI, and the other is Brent, which is a more global measure of the oil price. And this goes back over 20 years. What you can see there is back in 2020, the oil price unbelievably went negative. People were giving oil away, which is extraordinary. Now, over the period since then, you can see how much the oil price has gone up. So it's gone up from those negatives all the way up on these charts, which were to the end of September, to $75. And in fact, as of today, they're back in the kind of mid-60s. So that's a really big jump in oil prices. But what you can also see is that the latest oil price is not at the top of the chart. In other words, the oil price is not high compared to its history. It has gotten a lot higher. But that increase in oil prices is really important because it feeds through into almost every single part of the economy. Just about every type of manufactured good has to be made, has to be transported, and energy affects that. While the slides come up, I will just explain the key points we're looking to make here. And that is really that the inflation has picked up in the US, it's picked up in Europe. Interestingly enough, it hasn't really picked up to anywhere near the same extent in Asia. So in China and in Japan, it's not the case where we've seen the same pickup in inflation. So certainly those energy prices have had an impact, but there's also been some other factors at work here. And so what we want to do is to dig into some of the arguments that are being put forward about why it is that inflation might be high in future than it has been, and see whether those arguments are going to hold. So the first one I want to consider there really is an idea that central banks who effectively set the price of money are providing money that's too cheap, and that money they're providing is going to lead to inflation because they're printing too much money. So this is something which people have focused on and have been concerned with back in 2009 and 10, after the financial crisis, when we had very low interest rates and we had central banks also printing lots of money. Now, one of the main arguments here is that money is going to cause inflation because everyone will take that money and will rush out and buy lots of things, and they will buy things and they will borrow a lot more money. We have not seen that happen so far. And if anything, what we're seeing is that central banks are actually making some adjustments and are not going to sit there and just keep things as they currently are. So, and thank you for the screen that you can see there. We can identify clearly the point being made earlier, which is that inflation is picked up in the US and Europe, but not so much in Japan. Just moving on to the next chart. One of the things we're looking for is to see whether consumers are starting to change their behavior, because it's when consumers start to change their behavior that you start to see perhaps a longer term shift. Now, we're not really seeing that. This is just a survey looking at consumers' own forecasts of inflation. They have expected inflation on a 1-year view to go up, but on the 5-year view, it's not the case. So on the next chart, we can see that there's also the view that investors have about what they expect to happen to inflation. And this is a measure of the forecast for inflation over the next 5 years. And we're showing the US inflation forecast, that's in the green, it's in the middle line, the UK, which is the top, and the European one at the bottom. And pretty clearly what you can see is that there's been an increase in inflation expectations across the board. But But in the case of Europe, we're talking a 5-year inflation forecast of 2%. And even in the US, it's not especially high. So we haven't seen as yet anything to suggest that inflation, that consumers are changing their behavior in relation to inflation. So the inflation we've seen has not so far resulted in a big change in how people think about the future. But there are some other issues to consider before we can assume that this bump up in inflation is going to eventually come back down again. On the next chart, I just want to kind of making those points about energy being the key driver, and how we're sort of not seeing a big change in how people are adjusting their own inflation expectations. And on the next chart, we want to just explore these 3 arguments about what could cause inflation to go up: too much money, too much government spending, and then finally demand outstripping supply. Let's take a look at the next chart in terms of the too much money argument. So these charts show you effectively how much money has been printed, or the supply. The top is the US, the bottom is Europe. There was a spike up that happened in March 2020 as governments tried to rescue the economy, print lots of money, buy lots of things. And you can see that in both charts. And since then, that's come down. So whilst we could see this lead to high inflation if they kept on printing lots of money and lending it out, and then people borrowed that money to spend a lot, we're not seeing that. So we don't think actually that is a material risk, and central banks are indicating today that they want to rein things in. The next chart, we can see that the interest rate set by the US central bank, and you can see that there are periods going back over 20 years where it's gone up, it's gone down, and we've had that drop in interest rates that we saw in 2020. The markets are expecting interest rates to go up, and indeed the authorities are also indicating that people should be adjusting their expectations, and it's the same with the ECB. So we don't think that extreme stimulus is going to stay in place. On the next chart, you can just give that a minute to come up. So we're going to look at the second argument. The second argument is that the government is spending too much money, and in its stimulus that it's providing to the economy, and that it is doing it at exactly the wrong time. It's doing it at a time when there are not enough workers out there, and that is going to lead to wage inflation. So this is a chart that looks at the rate of unemployment in the United States and goes back to 2001. So when the number is high, it means that there's a lot of people who are unemployed, and there's a lot of excess capacity, spare capacity in the economy. When the numbers are very low, it means there's not much capacity. So we can see there the effect of the COVID crisis is that we went from a situation where really most people had a job to a situation where suddenly lots of people didn't have a job, and the incredible bounce back in the economy has meant that a lot of the people who were unemployed briefly during the COVID crisis have got jobs, and in fact some of them have left the workforce. So it does look as if the labour market is tightening up, and there are more jobs now than there were before and fewer workers. But you'll also see that line is not at the bottom, so it's not at an extreme value. And the other thing that's clouding this is the fact that many governments put in place special schemes where their governments paid people not to work, and those schemes are coming to an end, and so it's creating making it a bit harder to work out what's really going on. So again, we don't see happening. Also, US government is, I think my internet connection is, the US government is not legislation through the Houses of Congress. So all in all, we think this is an important thing to monitor, but again, we're not seeing it as the next chart. We will dig into this issue of how much the government's spending. just to be able to put it into some sort of context. So this is the difference between the amount that the US government receives in the way of taxes and the amount that it spends. And so it's spending more than it's receiving in taxes, which is why this line is in the red. So in the financial crisis and in recessions in general, governments do step in and spend more to compensate for the fact that households and businesses are spending less than usual. And 2020 was a more extreme example of that, but the bounce back in the economy has already meant that the government is getting a lot more in the way of tax revenues and is paying less out to people such as on these furlough schemes. So again, we think that this factor is waning. Turning to the next slide, we want to look at what I think is probably a much more significant argument in favor of high inflation, and that really is demand outstripping supply. What we mean by this is there just isn't enough stuff being made, there aren't enough workers, and that is going to cause prices to have to go up because demand has bounced back from the depths of the recession we saw before. So what is very clear about the last 18 months is how unusual it's been to have both the global economy everywhere suddenly stop as people were told they couldn't work anymore or had to stay at home, the factories shut, people lost their jobs, people spent less everywhere at the same time. And then once we've had the vaccination starting to be manufactured and tested out, and we had the initial controls keeping the vaccine from spreading, we had this tremendous reopening of the economy all over the world. And that meant we had this unbelievable pickup in demand. It's very unusual to see that kind of synchronized, huge increase in demand at the same time. So that massive increase in demand has occurred at the same time that many factories were not able to get back to their former levels of production. So they weren't producing as much because there were still outbreaks of COVID that were forcing factories to shut. We separately had an issue with shipping where fewer ships were being made. And so there were fewer ships being able to move things around. And on top of that, we had some special factors like a ship that was stuck in the Suez Canal, which resulted in big bottlenecks. And as the ports were closed, they also were unable to process all of this manufactured goods that were being sent around by ships. They weren't able to process it. So you had lots of ships waiting out in ports. So to lengthen the time it's taken for manufacturing to bounce back and for that manufacturing to reach economies, at the same time, there have been a couple of critical shortages. The semiconductors, which are these days a key ingredient of most manufactured goods, there was a shortage of those. And that's led to a shortage of things like electric cars. So that is something which has lasted a lot longer than anybody was really expecting. Now, we are seeing factories ramping things up. We are seeing investment in these areas where companies can make money by things like producing a larger amount of semiconductors. So we are seeing all the signs that will eventually lead to an increase in supply. But the outbreaks of COVID and other restrictions mean it's not a smooth ride and it's taking longer. The fewer aging workers, we are also seeing some rather peculiar things happen. And that is that some people have decided, because of the impact of COVID on health, on their jobs, they are not prepared to carry on working in those types of jobs. They've also had a lot more government support. And for those who were close to retirement, the bounce back we've seen in investment markets has meant that suddenly the savings of people close to retirement who invested in shares of property, they've gone up so much that some of them have now been able to retire. So there have been some folks who've retired earlier than they expected, some folks who've left the workforce, and this is particularly pronounced in the US. It is not the case in Europe, interestingly enough. And in fact, we haven't seen those sort of trends happening in Europe. In the UK, we've had some effect from Brexit, which have made things a bit cloudier. So there isn't really a widespread pattern about workers. that you could point to a global universal rise in wages and inflation. Now, the last point we're making here is the greening of the economy. And this is really about saying, look, if governments want to be able to stop using fossil fuels, then many parts of the economy that are still reliant on fossil fuels as their main source of energy, effectively all those factories and products are redundant. We won't be able to use them. So there's lots of capacity that simply won't be able to be used. And that could cause an increase in price. I think actually a similar issue, or just as an important issue, is, and this relates back to the energy, is the fact that the decarbonisation, the attempt to wean ourselves off coal and oil and gas, has meant that most economies have become much more sensitive to the production of solar and wind. And that means that when we've had unusual periods where there wasn't enough wind producing enough power generation, or indeed solar, then there's been actually a shortage of energy. And what we've seen is suddenly people have had to revert back a lot more to oil and gas. And it's the big East European economies, Japan, Korea, China, who are very gas dependent. So they've ended up having to increase and consume a lot more gas because their solar, hydro, and wind sources of energy were producing a lot less. They're trying to wean themselves off coal. They're not pumping up nuclear. And so a lot of gas that was, for example, due to make its way to Europe has ended up in Southeast Asia. And that's contributed to the rise we've seen in gas prices. So all of those things suggest to us, plus the fact that there's huge investment going on in solar and in wind farm production, that this is not a structural increase in the cost of energy we're seeing. It's more a factor which over time we would expect to reverse. So on the next slide, we are showing some measures for industry about these supply chain constraints and how companies in their recent reporting season have indicated that this has been an issue for them. Industrial staples, materials. The chart on the left at the bottom of those industry, the bottom of the industries are the ones that are being affected, and a lot of industries have been affected. And on the right-hand side, a question mark about how long those supply constraints may last. And they're going to be lasting well into 2022 and possibly into 2023. So there is still a possibility that this does continue to drag on, and it could feed its way into higher inflation in general, but we still see this ultimately as being a very competitive world with lots of supply. Next chart, please. On the wages side, this is the point about wages. The right-hand side shows you the wages in the US, which is the highest line relative to the wages in Germany. So you can see that divergence between what's happening in the US and elsewhere. And the left hand side chart is this issue around people switching jobs after the effect of COVID and people looking for higher paid work. Next chart, please. So we put forward the arguments. I think what people sometimes forget, though, is that we've been in an environment for probably 20 years where inflation has continued to be lower than central banks really wanted it to be. And that's because innovation and competition have still been very strong. So the robotics we've seen, artificial intelligence, these things, if anything, are actually ramping up and becoming more applicable. What that is doing is it's making it cheaper to produce goods and services. And as you'll know from your own shopping with the likes of Amazon and internet purchases, it's meaning that people have very wide choice. China is still an economy that needs to produce a lot of goods to keep its population employed. And so we're seeing this idea that competition is still pretty strong, and that's stopping inflation going to the runaway levels. In terms of what forecasters are saying, we've observed over time that forecasters themselves have a lousy track record and tend to overstate inflation. And we're seeing that the central banks are responding to what they're seeing as a rise in inflationary pressures, and governments haven't been able to spend as much as they were intending to. Lastly, I would just add there that COVID outbreaks may continue to impact demand. We're just seeing the effect of the most recent COVID outbreak with the Omicron, and that has contributed to lower oil prices. It has also opened the door again for less socializing, less spending on services, less spending on goods. So it's not the case anymore that demand can only increase from here. We've had the big economic rebound. Now we're back to a world where demand could be less than people expect or more than they expect, and we're having heavy investment in those areas where prices are high and there are shortages, which will eventually flow through. So next slide, please. We think that when it comes to investing, it's pretty tough to know exactly what the future will hold in terms of inflation. But what we do know is that if you buy markets when they're cheap compared to their history, you get a better return. This chart on the left is showing that. So if you look on the left-hand side of the chart, that is telling you what happens to future returns when markets are cheap. And so you can see the line is higher. On the right-hand side of that chart, you see when markets are expensive and the future returns are lower. So we know for a fact that, and this study has been done for a large number of countries over a long period of time, buying markets when they're cheap increases the odds of getting a better return that will be higher than inflation. And we think that's a better path to protecting your wealth from the effects of inflation rather than guessing inflation and only holding assets which might do well when inflation goes up, but which may also do poorly if inflation doesn't go up. Next chart, please. So for portfolios, we also think you should stress test. We look at all the different things we hold in portfolios and what they can do in a high inflation environment. So it could be different industries can perform better than other industries, different currencies can perform better than other currencies. So we think looking at the stress test of how things can behave in different environments is helpful in building a portfolio that can handle both inflation being higher than you think, but also other types of economic environments, because that's not the inflation environment isn't the only one you should be worried about. There are other environments that you also need to take into account. Next slide, please. So the points we wanted to leave you with are that we are still in a low inflation environment, and the history suggests a low probability of moving from where we are to a high inflation era. So a lot has to change. High inflation is the worst scenario for share and bond market returns. And here we're talking about, inflation of 5% per annum on an ongoing basis, not just for 1 year or 2 years, but for an ongoing basis. The recent rise in inflation has been fueled by rising energy prices, supply constraints, and surging demand. We think that the majority of those pressures are more transient than permanent because there's a supply response, and also because demand did bounce back to very high levels and is now getting back to more normal levels. And therefore, there are shocks that can happen which also affect demand on the negative as well as the positive side. From an investing perspective, we think it's better to seek out assets that offer better value because they're more likely to give you returns above inflation, and to use scenario analysis to make sure your portfolio can handle a situation where inflation is higher than expected. I'm going to stop the presentation there in terms of the formal slides, and looking forward to opening it up to any questions.
So, Mike, we indeed have received some questions while you were giving us your presentation about inflation. In the meantime, I would like to remind everyone that you can still submit other questions you might have through the Q&A function, which you will find available on your screens. So, Mike, starting off, in your opinion, which investment types, which securities do best when inflation is actually high?
That's a really great question, Ingrid. So the investment which is most closely linked to inflation are inflation-linked government bonds. So these are bonds where the interest or the principal that you get back at the end of the period goes up with inflation. And we have held those assets in our portfolios at times when we felt they offer particularly good value because investors weren't expecting inflation to go up. And we've held them in portfolios, but what we found is that as people have started to think more about high inflation, they've bought lots of those assets. And so now those assets aren't as attractive. But that would probably be the best asset to buy if you're really, really worried about high inflation.
Okay. Another interesting question which came in is, why is actually inflation higher in the US than it is in Europe at the moment?
Yes, that's really interesting. I think it's to do with the way the job market works. So in the US, the government was directly paying people, and the economic model in the US is to very quickly for companies to sack people, to make them unemployed. Whereas in Europe, companies have tended to hang on to people to a greater extent. And we've also had a situation in Europe where people had already retired early because of some of the very generous pension scheme arrangements. My internet connection is unstable, and so some of them had already withdrawn themselves from the labour market, whereas in the US there was a greater response of older people to wanting to retire a bit earlier because they could afford to. So you had a greater proportion of people withdrawing themselves from the labour market in the US than in Europe. And so we've started to see more in the way of labour shortages in the US than we have in Europe.
Okay, so that is very interesting, seeing that obviously the labor market does really affect inflation quite a bit. Looping into the same question, so in your opinion, what is the possibility that within the EU in the next 2 to 3 years we'll see either hyperinflation, stagflation, or any other scenario? So what is, in your opinion, the highest probability of what we'll be facing in Europe?
Well, I think we can discount the scenario of hyperinflation. That is very unlikely to occur because of the way the economy's set up, because of the sensitivity of policymakers to high inflation, and also because of the amount of people who are still unemployed. So we'd probably think of that as the lowest possibility. There is still a possibility of deflation in Europe. So people not spending money, people being more cautious about things, particularly if there's money having to be spent on rising energy costs. Our base case is probably a continuation of a low inflation, or 1 to 3% per annum ongoing inflation environment. That would be the most likely.
Thank you for that. So I have two questions which are quite similar and possibly tied. So what effect will climate change action have on inflation? And obviously the fact that now we're greening the economy, all the pressure is being put on having a greener economy. How is this going to impact inflation in the next few years?
So the area where that is most evident is energy consumption. So what we've seen so far over the last 5 to 10 years is governments incentivizing the companies who produce power in their economies that generate electricity to diversify away from the high polluting sources of power generation, which is coal and gas. But and they've done that, through investing in solar, through investing in wind, and there's been a mixed pattern around the use of nuclear. There was a backlash to nuclear after the nuclear power generators where we had in Japan after the tsunami, where there was pollution coming out of that. And I think some of the case for using nuclear in Europe, particularly Germany, are kind of unwound. I think that's being revised, and really depends what governments do with nuclear, because the issue we have with using solar and wind for power generation is that sometimes it doesn't really work well for peak periods of use, and you need a stabilizer in the system to continue to produce a certain proportion of energy So it sort of depends how quickly governments decide to completely withdraw themselves from gas. If they do that extremely quickly, then it could be that the cost of energy goes up, or that governments decide to more heavily subsidize the cost of energy in terms of power generation. The other side, of course, is transport, and there just haven't really been a big enough move forward in government supporting electric-based transport, and that will have to mean that lots more money gets spent by the government on specific industries to then allow that to happen. So the energy costs are probably the thing that's hardest to forecast. Usually what happens is, in the short term, you get an increase in the price as people switch and the supply of new types of energy aren't high enough. But because you're getting a really big extra amount of investment in solar and wind generation, then actually the cost of that continues to fall quite dramatically. And then on a sort of 5-year view, actually the cost of energy could be a lot lower than it is now. So that is probably going to have some a push down, and energy probably is the single most important component of inflation, where you could draw a conclusion. The other elements are much harder to be able to really know exactly what effect they'll have.
Thanks for your detailed response there. We still have a couple of more questions to go through. What is the effect of COVID on inflation, and what do you think will happen to inflation? I mean, at the moment we're seeing the new variant coming in, a lot of speculation with what will happen with it. So what does this have? How does it affect inflation in reality?
So COVID in the short run, so the way to think about it is from a demand perspective, and from a supply perspective, and then a government response. So when COVID outbreaks happen and the government response is to stop people from working because they are unable to go to the place of employment, and that there's certain industries, particularly service industries, where because people can't leave their houses, they can't spend on those services, and therefore those industries go into big losses. That tends to push down prices. People spending less means less demand, which means it pushes down prices. It's actually quite deflationary. If you look at the inflation trends in Q1 2020, you can see exactly that. Prices were falling of everything. So in an extreme COVID situation where economies are shut down again, you would expect that to put downward pressure on prices because demand is going down. The offset to that, of course, is supply, and whether supply gets reduced also by a proportionate amount, such that there's just there isn't enough stuff. So you're really balancing those two factors, and at the moment it's almost impossible to know which of those would play out. Clearly, we know if the world shuts down, it's like a huge recession. People lose their jobs, prices and demand falls, and that is what wins the day, and it pushes prices down.
Okay, so most of us tend to view gold as a safe haven. How do you feel about gold being the investment security to go for?
Yeah, gold is a really fascinating investment. As we look across time and across markets, what we've observed is that gold is a combination of two things. It is actually giving you some exposure to the US dollar, because gold is ultimately priced in US dollars. And so if you're living in a country where you can't access banks, where you have no investment opportunities, and also where inflation is high, your own currency is falling all the time, then gold is actually a great asset to have. And so in more primitive societies, gold has been held as a store of value. And so for many folks who live in India, who are totally outside the modern economy, it makes perfect sense for them to have gold. in a sophisticated modern economy with low inflation, there are other assets which much more directly protect you if inflation goes up, or protect you if there is a recession where prices fall. And government bonds, good quality government bonds do that. They do provide you protection in periods of recession. So gold is an asset that you would tend to hold if you were very worried about the future of the banking system, if you were very worried about economies reaching a stage almost of, if you like, civil war, unrest, chaos. And in that situation, people flock to gold as a reliable asset. But in most other situations, really, it has a kind of a strange role where in the long run, it sort of keeps pace with inflation. But in periods of crisis, actually, people sell it. So in the Asian crisis in 1997, 98, the biggest holders of gold typically are the Chinese and the Indians. They were selling gold in a crisis because they need to realize their assets to pay for things. So, and we also saw that in February and May 2020, gold price went down. So gold tends to go up when people, are very concerned about the future of banks, or they feel that there's a high risk of hyperinflation and there's nothing else they can do. And we saw the same increase in demand for gold in 2011, 2010, after the financial crisis, when people were worried about banking system, and after a period where interest rates were cut to very low levels and people were worried about central banks printing money and that ending up with hyperinflation. None of those things actually happened. And then those who had gold at the time lost quite a bit of money. So gold is a pretty speculative asset. It doesn't generate cash flows. You need someone else to buy it from you. And so actually, because of the fact it doesn't produce cash flows, it's probably one of the most speculative assets you can buy, where you're really in a guessing game about what others will want to do in terms of buying gold. So we don't tend to think of it as a major component of any of the portfolios that we manage, but there are very specific scenarios where it can be worthwhile having a small exposure to it.
Perfect. So I'm going to move on to the last question for the day. So earlier on, you gave us your views about what would happen, what you think will happen in Europe within the next few months, years. What are your views on the US market? Do you think the scenario with inflation there is going to continue being different to the one in Europe?
So in terms of the US economy, it rebounded the strongest. It had very immediate government support in the crisis last year, and the Biden administration wants to very aggressively spend money on infrastructure, greening, and the extent to which they can do that depends on whether they can kind of get the legislation through Congress. And they've had mixed success. Plus, he's coming up to the midterm elections, where normally you lose some of the majority you've had, and it makes it very hard to put through bold programs. So I think the US has had that stimulus. It's also had a global powerhouse of companies benefiting from the shift online in terms of how we live our lives. And that is probably going to still be a support. So the US economy is still pretty strong. We think that will carry on. People on the back of those things have really liked US equities and have bought lots of them and made them really quite expensive. So we, as long-term valuation-driven investors, see the US as being less attractive because people are paying too much money to own what are very good businesses, but they're paying too much for it. Separately, Europe, is coming through the crisis, has its own unique issues to contend with. There was definitely an effect of Brexit, which is working its way through the system. It's having to deal with the energy, the rise in energy costs. And that there's some other specific issues that are affecting the economies there. We think the assets are probably better value in equities, but bonds are more problematic because the yields are so low in Europe. It's a real challenge to find fixed income investments. So we actually prefer US fixed income investments and non-US equity investments.
Thanks for that, Mike. Very interesting session, and it was really great to have you share your views with us. A big thank you also goes to all of you who joined us today as we come to an end of another MeDirect talk. Please note that our team of advisors are always available if you have any further questions. Thank you once again, everyone, for joining us.